Hello and welcome to the Joe DeLisi Financial Advising Podcast. Hey, little podcast here just designed to give you some quick little tidbits and actionable advice. And today we're going to talk about, do you want to retire? Of course you do. But for decades now, the financial services companies have convinced Americans that really the only path to retirement is through the equity markets. Now, whether or not that's true is pretty open to interpretation. However, there are many recent industry studies and they show that Americans' retirements really are no better off now than at any point in the past. In reality, they may be getting worse. Now, I love the stock markets. I really do. And if you've worked with me for any period of time, you know that. And for most of my clients, and really for myself as well, the equity markets are our main line into the veins of capitalism. And capitalism is without rival in increasing the well-being of mankind. And true capitalism is the creation of products and services that creators make available to the public. The public then, through the marketplace, they pick winners and losers, and the winners, those products and services that are enjoyed most by the marketplace, they create massive wealth for the owners, and the losers, they leave with nothing but the opportunity to try again. Most of us probably won't participate in true capitalism, like pure capitalism. We aren't creating products and services out of thin air. However, we are able to participate in the marketplace by purchasing stocks, bonds, ETFs, mutual funds, and the like. Through the ownership of these instruments, we're rewarded for our risk and our capital through rates of return. And that should be equal to our risk. And this is over time, right, of course. And it's not linear, of course. I wish it were. And it's really in the participation of this marketplace where we can truly grow wealth that can outpace true inflation. So what is true inflation? Now, we've heard a lot about inflation recently. But really, people are just talking about the CPI or the Consumer Price Index, and it's far more personal than that. It's the cost of new technologies that don't yet exist, but that will be necessary in the future. Like, think back to 2000. We didn't have iPads, we didn't have iPhones, and now we have to have them. Most families have several iPads and iPhones or Android devices. It's the rise of new taxes and really the increase of old taxes. Maybe the addiction to an increased lifestyle as we earn more. The replacement of things that are actually designed to wear out, and things like healthcare, and maybe even the healthcare and the general care of extended family. That is true inflation. And that's why we need to participate in the equity markets, as they really are the only hope that we may actually be able to keep up with that pace of true inflation. But all of us one day will need an exit plan for those markets. Retirement. All of us one day will either be forced out of the workforce or we're just going to simply desire to leave it. And on that day, an exit plan is required. So what is a exit plan? Well, the business owner knows this phrase pretty well, or they should. It's the pre-designed plan somewhere 5 to maybe 10 years in advance of the sale of his or her business. And a business owner would understand two things about retirement. Number one, they no longer desire the ebbs and flows and the stresses of running the business that's provided them with income and assets. And then number two, they know they need to replace the ownership of the business with the ownership of a portfolio that provides the income for the future. A business owner prepares for this exit, again, a decade in advance. They don't just hope for the best. You don't just wake up at 60 or 65 as a business owner and say, I'm going to exit next year, let me work on it now. But the ordinary high-income earner in America is not doing the same work. Like, they're being taught that only the markets will provide them the wealth to replace the paychecks they're used to receiving, that inflation battle. But those markets are the only thing that they need to have in retirement. But that's not necessarily true. In fact, does that even make rational sense? I'd say no, not at all. So go back and think of your career as a high-income W-2 earner. For decades, as long as you kept your job and did good work, you received a paycheck. You didn't worry about the price of the stock of the company or, that you worked for your paycheck. That money just came into you every 2 weeks. But then at the moment you're most vulnerable, at an advanced age where you don't have decades of earnings ahead of you, you're being told that you can simply move away from 30 to 40 years of paychecks promised and just move towards all your paychecks coming from the stock market, which are volatile and nonlinear in their production of returns. So you're doing the exact opposite of the business owner. He or she, they're leaving the risk behind, and they're taking the easy path forward, but you're doing, again, the exact opposite. You're leaving the every 2 weeks pay stub behind, and you're entering a world of stress and volatility in the stock markets at the age of what? 60, 65, 70? And that market, that return, it's not promised. It goes up, it goes down, and sometimes it goes down for 2 or 3 years. When were you ever in danger of that during your working career? You weren't ever in that danger. But now at 60 or 65, are you actually willing to take that risk? And why? And the answer is because you're told to. You may be told to take that risk from many brokers and authors and banks and wirehouses and even financial planners out there. If anyone suggests you own some guaranteed assets like life insurance, cash values, or income annuities, they're shouted down by the echo chamber of financial service providers and social media influencers. Now, I've been doing this job for 25 years, and I can tell you one thing. The one thing that keeps me personally up at night, the one thing that I don't think I could actually ever recover from, is if a client took my advice, listened to what I said, and then ran out of money in retirement. I can't let that happen, and I won't let that happen. And the great news is this needs not happen to anyone. Every single one of you listening to this can have a retirement built upon guarantees and then supplemented by my beloved stock markets, not the other way around. The reality is the math may actually dictate in many cases that having life insurance and long-term care insurance and annuities in retirement is actually the better mathematical play. It's a smoother income strategy for sure. It's a better, in many cases, tax strategy. And it's the strategy that will allow you to most closely recreate the paychecks you've learned to live on for the last 3 or 4 decades of your life. So why then do these social media celebrities and authors, why are they saying otherwise? My guess, it's the easy path. I mean, it's easy advice. Everybody says it. They don't have to sit down one-on-one with anyone. They don't even have to have a license to practice insurance or financial planning. They answer to no one if what they say doesn't work. They're not going to be there if your plan falls apart when you're 75. But I will be. I've been doing this again for 25 years. I'm practicing on no one. And yet, I'm nowhere near retirement myself. At 49, I still have 6 kids, all under the age of 16. My path to retirement for myself is simple. I have guaranteed income sources I've built over the last 25 years, and I'm going to continue to fund for the next 2 decades. I have millions of dollars of permanent life insurance in place to help me with guaranteed cash in the event I need liquidity in bad years of the stock market or in the event that I die. And I supplement those 2 foundations. Again, those are my foundations. I supplement those 2 with a heavy dose of equities, diversified around the globe. My savings rate is high and my protections are deep. My plan is well designed, and there aren't many threats that can take my future away from me or my family. If that's what you want, I can help provide that to you. What I can't do is argue with you over articles or posts you read on the internet. If you're looking for the path to retirement, I can help you. If you're looking for the path of least resistance and the lowest savings rate and a path built entirely on hope, then the only thing I can promise you is years of worry about every event that the media is going to throw at you. It doesn't sound like much fun to me. So before I move on to the ever so important disclosure piece, I just want to remind you to please subscribe to the podcast. Feel free to share it. There's a link in the show notes, and that will take you to somewhere you can go and you can kind of take a little quiz as to where you're at currently financially, or just share it with a friend or family and they can do the same. You can even click to meet with us through that link. Now for the disclosures.
Joseph DeLisi is a registered representative and financial advisor of Park Avenue Securities, LLC, OSJ 5280 Carroll Canyon Road, 300 San Diego, California, 92121 619 648 Securities products and advisory services offered through PAS, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of PAS or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC. CA Insurance License Number 0D34103. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Guardian and its subsidiaries do not issue or advise with regard to mortgages, property and casualty insurance, and/or car insurance. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both both real and perceived general market, economic, and industry conditions. Investing in securities of smaller companies tends to be more volatile and less liquid than securities of larger companies. Investing in the bond market is subject to certain risks, including market, interest rate, issuer, credit, and inflation risk. This material is intended for general use. By providing this content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation or to otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged and one cannot invest directly in an index.
868-768-9.1 expires January 2038.